Welcome, ladies and gentlemen. In today's video, I want to focus on the right crypto assets to invest in, because it's ultimately the ones with real utility that matter. It's those assets whose use cases and functions will very soon be reflected in their price once we shift into the utility phase of crypto adoption. Now, as early positioned investors in this industry, however, much of crypto still remains a speculative, Ponzi-like environment, full of projects that we've seen have no substance, no real use cases, and no regulatory clarity. Now, fortunately, this is changing, with increasing regulatory clarity through the Genius Act regulating stablecoins and the upcoming Digital Asset Market Clarity Act, which aims to wash out bad actors through structured licensing, transparency, and enforcement mechanisms. We're beginning to enter a phase in the industry where market manipulation will explicitly be targeted, insider trading will become prosecutable, unregistered token issuers will face shutdown, and transparency frameworks will make deception unsustainable in a licensed ecosystem. And once the noise is cleared, only a few key players will remain. But before we get to that, we need to address the red herring that is Bitcoin. You see, Bitcoin was initially designed to function as a peer-to-peer currency. However, in practice, we see that settling a payment can take anywhere from 10 minutes to over an hour, depending on network congestion. This is far too slow, and it's not at all viable for global payments infrastructure. The narrative then shifted from currency to store of value. But a store of value must surely show stability. And when people talk about Bitcoin as a store of value, I'm curious as to what store of value you're on about here when we see its price can swing 30 to 40% in a single day. Yet again, global finance cannot run on volatility like this. We also need to discuss the pricing mechanism itself. And I'd like to give a credit to a guy named Jacob King on X. This is one of many, many posts covering this topic. I've just selected one here. Jacob King does a great job documenting how much artificial manipulation and fake synthetic liquidity on the part of Tether continues to flow into Bitcoin markets. You see, much of Bitcoin's current buy volume comes from newly issued USDT entering exchanges, artificially propping up its price. And this, ladies and gentlemen, is fake liquidity with synthetic dollars. And what I want to ask you is, how much longer can an entity continue to print billions in synthetic dollars to prop up a market driven entirely by speculation? And that is why a significant market correction is inevitable. That is why speculative liquidity will be replaced by regulated liquidity. And Bitcoin, I believe, should certainly reprice to reflect its utility eventually. And its utility, crucially, is limited as it does not support institutional grade tokenization, which leads me on to my second point. How many of you are familiar with tokenization and the impact it will have on global finance? For those of you who aren't familiar with tokenization, you might have heard the term, or this is the first time you're hearing of it. Tokenization is basically the process of converting ownership rights of real-world assets into digital tokens on a blockchain. So each token will represent a share of that underlying asset, whether it's real estate, currencies, bonds, commodities, art even, right? Anything that is physical or off-chain, which we convert into something digital and transferable on-chain. So an example, as I say, could be real estate. So to tokenize a $10 million property, you could divide it into 10,000 tokens at $1,000 each. All right. Government bonds as well, treasuries, commodities, equities. These are all examples of tokenized assets. Okay. You will be able to trade assets that are normally illiquid. And as investors, we will be able to buy fractions of these high value assets. And as well as fractional ownership and global access, tokenization will also enable 24/7 settlement. And this will be an incredibly transparent process too, as blockchains, as we know, record ownership and transfers openly. And that is why major institutions like BlackRock, JP Morgan, Citi, Franklin Templeton, and many others are exploring real-world asset tokenization as we enter the next phase of finance. Now, we are still extremely early. As I say, you ask your everyday bloke on the street what any of this is, ask them what tokenization of real-world assets are, they won't have any idea what you're talking about. As we stand only, as we see here, only $200 billion of the 1.64 quadrillion global asset base is tokenized today. Bitcoin isn't going to capture any of this value here. And why is that? Because tokenization requires liquidity bridges and instant settlement, which leads me on to the next project here. Well, obviously we'll cover this as well, but the next project here. This project, ladies and gentlemen, if you follow the money, if you follow the goals and ambitions of the world's largest financial institutions, if you dig through IMF papers, Bank of International Settlement reports, CBDC central bank pilot documentations, there is one project that keeps appearing at the intersection of payments, liquidity, settlement, and tokenization, and that is Ripple's XRP. And why XRP? Because the XRP ledger isn't just another blockchain. It's an infrastructure layer built for what traditional finance actually needs. Speed, efficiency, and scalability at a global level. All right. And let's just take a look at the two systems here. All right, XRP and Swift. Swift is a highly outdated messaging network where payments take days, require multiple intermediaries, and force banks to lock up capital in Nostro Vostro accounts. Whereas the XRP ledger, you can see the value settles in seconds, verified on a decentralized ledger, and no pre-funded accounts are required. And XRP has long been recognized for enabling cross-border payments. Indeed, the CEO of Ripple, Brad Carlinghouse, at an event earlier this year confirmed that they would look to capture 14% of Swift volume by 2030. Let's just take a look at that clip here.
Swift today, and there's two ways to think about Swift. There's a messaging, and there's liquidity. Liquidity is owned by the banks. I think less about the messaging and more about liquidity. If you're driving all the liquidity, that's good for XRP. Anyway, so I'll say 5 years, 14%.
So bear in mind that the average daily volume of Swift-enabled financial transactions is estimated at over $5 trillion per day. This is the value of the daily movement of funds between banks, corporations, and institutions. And capturing even a single-digit percentage, never mind 14% of the volume, is transformative for those that invested in XRP. Now, to actually break down XRP, the XRP ledger, into a more sort of visual, give you a more visual understanding of how this works, we need to take a look at on-demand liquidity. XRP is purpose-built to serve as a neutral bridge currency for exactly these kinds of high-value cross-border liquidity flows. And the way it works is that through ODL, on-demand liquidity, RippleNet customers can use XRP to bridge to fiat currencies instantly without needing to pre-fund accounts in each country. So the way it works, obviously, is the sender will initiate the payment in their local currency, say American dollars. That USD is converted into XRP through an exchange in real time. The XRP is then transferred across the XRP ledger in 3 to 5 seconds, and on the other side, it is converted immediately into the recipient's local currency and delivered directly into their account. Now, this entire process eliminates the need for Nostro Vostro accounts, which is going to free up trillions in trapped capital sitting idle in banking networks, because under the SWIFT system, Under the SWIFT system, banks have to currently pre-fund accounts in other countries to facilitate cross-border payments. So let's say that a US bank frequently sends money to the Philippines. It can't just send dollars instantly, so it will keep millions of dollars parked in a local Philippine bank account. That's its Nostro account to make the payments when needed. And then the Philippine bank, meanwhile, will do the same in reverse. It will keep pesos in a US account. That's its Vostro account. Now, if you multiply that arrangement across tens of thousands of financial institutions in over 190 countries, across dozens of currencies, that, as I say, is trillions of dollars sitting idle every day, doing nothing but waiting to be used for cross-border transactions. That is trapped capital. It's money that could be used for loans, investments, or business growth otherwise. But instead, it's locked away to maintain and prop up this old, slow, message-based SWIFT payment model that will eventually be replaced. I truly believe it. Because as I say, Ripple's on-demand liquidity is going to remove this. It's going to convert currency into XRP back in seconds. It's going to free up trapped capital. And that will unleash a flood of liquidity into the global economy. And you hear people talk about how crypto is all entirely a scam and useless. Well, maybe for 95%, maybe 99% even, but not these special projects here that you really need to look into, ladies and gentlemen. And as I say, ladies and gentlemen, the XRP is not just designed for payments. If we go back to tokenization, as I spoke about earlier, the same infrastructure that bridges currencies can also bridge tokenized assets, right? The same technology will be able to provide liquidity for tokenized assets, which effectively turns the XRP ledger into the underlying plumbing of a new financial system. Even if a fraction of the 1.64 quadrillion in tokenizable assets flows through the XRP ledger, the implications, as I say, for global markets and XRP investors will be profound. And why XRP? Why will this happen in the XRP ledger? Because again, to tokenize a real-world asset, you need liquidity, speed, and settlement finality. Okay? And so utilizing Ripple's on-demand liquidity, the same mechanism which they use for payments, can also be used to bridge tokenized real estate to fiat, settle trades between tokenized bonds and stablecoins, and it will happen because speed is everything, and that is what the XRP ledger offers. Okay, speed is everything for these institutions. You can't tokenize $10 billion in bonds and wait hours to confirm settlement. You can't do it on networks like Bitcoin and Ethereum with network congestion and high gas fees. Same goes for Solana as well. Explain to me how institutions would be keen to tokenize trillions in real-world assets on a network that relies so heavily on speculative retail activity to sustain liquidity, whereas XRP, on the other hand, was engineered to power the world's financial transactions. So before I close, I want to address a common objection. You might be thinking, surely there's a payments-focused, tokenization-focused XRP 2.0 out there, a newer project that does all of this better. And if so, I have a challenge for you. I'd like you to find me a network referenced more frequently than Ripple and XRP simultaneously in IMF documents, Bank of International Settlement reports, central bank digital currency pilot research. Name me a network, name me a project like this that is more tightly connected to global banks, card networks, and prime brokers. And I would discourage you for pointing out to Stellar Lumens as XLM. It's a project that I'm of course invested in, but that is an apples to oranges comparison. You're comparing, as Edo Farina says, a Rolls Royce to a Rolex, right? Both are excellent at what they do, but built for very different purposes. One is engineered to settle value as a neutral bridge layer at scale. The other will focus on micropayments and remittances for retail use. So if you can show me a better connected, more institution-ready alternative, I will feature it. Until then, and I'll change my view. But until then, it's clear that the evidence points to XRP as the infrastructure grade contender for payments, for tokenization. And my final message, ladies and gentlemen, is, as you see here, there's only 6.8% of the global population truly engaged in digital assets outside of institutional ownership. Of that 6.8%, how many in XRP? Of those investors in XRP, how many of them own their crypto in a private wallet securely in the event of any, cyber black swan events, anything like that that compromises exchanges, or a supply shock that will forbid those from transferring or exiting their holdings on an exchange due to insufficient liquidity? Now, of that even smaller fraction, how many will withstand the test of time? How many of them will remain holding XRP at 10, 20, 30, 50, 100, 500, $1,000 per XRP? How many of them will remain firm in the face of disinformation, market liquidations, increasingly harsh economic times, debts, so on and so forth? More and more holders will continue to be shaken out. Hence, my message to you before I sign off here is, do not think it is impossible for the real value of this asset to eventually reflect in a post-speculation, utility-fueled, legislatively defined and clear, secured market. You are an early adopter. Early requires time. Your investment will take time to mature. Every generation had its golden asset, golden stock, if you will, right? Microsoft in the 80s, Amazon in the 90s, Tesla in the noughties, Bitcoin 2010s, 2020s will be through XRP. And you're thinking decades and not days. As I say, nothing in this video is financial advice. Do your own research before making any investment decisions. I'm not telling you what to do, but frankly, this is where I stand, and this is where I have my skin in the game. Thank you.